Hey, good afternoon, everyone. Welcome back to Watch Your Six. I'm Jason Edwards. Hope you had a great week. We figured with the beginning of the year in mind, we would talk a little bit about 2026. And we're going to try to maybe look at some of the components that you're hearing on the noisy boxes and the talking heads and sort of diffuse some of those so that we take some of the fear out of the environment. And when you take fear out of the environment, you add fact, it has a propensity to make things a little more calmer, but give you more advice. Now, there are some bearish people about the economy out there, but for the most part, we are seeing a tremendous amount of bull-type environments for 2026. These are indicators that are driving the traditional analysts to look at markets being very unique. For example, Goldman Sachs and Morgan Stanley have the S&P going all the way to 76 to 7,800. Why is that a big deal? Well, when those indices start to get to those type of numbers, that shows you that's incredible potential for profit margin and profit growth. How does it translate to you, my listener or my viewer? Well, it translates to your 401k, your IRA. It translates to your decision on should I start investing and how do I invest. It translates to you as an individual becoming wealthy. I think it's really critical, and people don't understand this, but I do it all the time, and I meet with a lot of clients. For the first time in years, you have an environment now where the average person can be a millionaire. And I'm not just saying that to say, well, you're just rich. No, if you deploy the right tools, like we talk on this show, and if you invest in these environments, you can make tremendous yields. There are projections from analysts that are talking about profit margins in the S&P and the Dow of double digits again for 2026. That means these companies are going to be posting projections of growth of 12, 14, 15%. That means your money could grow at those levels. We've had GDP now in astronomical numbers. There's a projection again for first quarter, second quarter that we might have 4% GDP. Why is that a big deal? Well, our GDP is an indicator of how strong our country's economy is. So when you have an economy at 4%, that means that we're generating a 4% revenue on one of the largest economies on the planet. And that means that resources like consumer spending will be there. So those individuals like you and I are going to have technically more cash. We're also seeing inflation come down. Now, we know when we go to the grocery store, the prices aren't down to where they were 5 or 6 years ago. But we're seeing prices come down dramatically. Inflation's a little bit over 2%. Remember, less than a year and a half ago, we were talking about inflation at 8 or 10%. So those are huge, what we call tailwinds. And you've heard me talk about this before. When you look at economic environments, what is there out there that you feel is going to make the market grow? It's going to make the market be more robust. Another thing is the Fed. The Fed is discussing the possibility of dropping rates. Why is that good? Well, that makes money cheaper. And when money becomes cheaper, things like rates on mortgages drop. The opportunity for companies to get loans expands. Those are all positive things as it comes to in investments and opportunities investments. Now, where do we invest? Well, the big buzzword right now still is AI. You're looking at almost $2 trillion will be generated by AI this year by the second or third quarter. 2 trillion, that's astronomical. So while AI is a good opportunity, it's also critical to look at what I call the branches or the pieces that make money off of AI. See, AI is a tool. It's a phenomenal tool, but you also have to look at other sectors like finance, health, consumer staple. They make money because of the AI market and because of the market we're in. Walmart is a great example. Walmart is using AI to be more efficient. Now, Walmart is not an AI company. Walmart, as we know, is a consumer company, right? They make money on you buying their goods. But if they become more efficient because of AI, which means that their costs come down, what's going to happen to their profit? It's going to go up. So what do you think is going to happen to their stocks? It's going to go up. Now, did you invest in AI or did you invest in Walmart? Well, you know the answer, but it's because of AI that those resources are now there. Those resources that give you a better opportunity to grow. So when you're in this environment right now, consider the things that we're looking at. Bond yields are low, interest rates are low, you've got the opportunity to access cash, and we're seeing inflation start to come down very low. That will translate eventually to energy costs, which are also coming low. So when you take all of those compilations, that means what for 2026? Well, that means you've got an opportunity for a phenomenal bull market. Now here's the catch. What do you do with that? Do you sit? Do you wait? Do you start to build an investment strategy? Do you start to deploy your investment strategy? Well, on Watch Your Six, one of the biggest things we talk about, most of the deficiencies that happen to you are what? Your propensity to debate, and I call it paralysis by analysis. You wait, and then the opportunity's gone. And that's going to be the same with 2026. 2026 is going to be a very robust year for investment growth, particularly in equity markets. Now, the US is not the only market that's going to have opportunity growth. Japan is looking very attractive. Some of the international markets are looking at 14, 15, 16, 20%. So we have opportunity to be, again, more diversified. But when you look at the fundamentals of things that you want to invest in and the opportunities, you have to have a plan. We talked about this before. You can't just go buy an online app, start buying some things like NVIDIA and say, great, I made a fortune. That's not how that works. You have to have a plan where you've got systematic investment strategies designed to match up with what we think is happening in the marketplace. So, well, as we mentioned, AI is going to be a big part of 2026. So will healthcare. So will financials. So will consumer staples. So will transportation. These are the areas that are going to have incredible resources and are going to benefit. We also have talked in the past, with AI, we see that there's a huge need for what? Power. Power, and you hear that all the time, energy, 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 energy. Well, you want to start looking at the alternative energy spaces like fossil fuels, but also nuclear. Some of those areas are really expanding now because they create tremendous amount of energy with very little waste. But if you're not looking at those things, if you're not taking the time to meet with a financial team and come up with a strategy, all you're doing is getting data. And you become one of the smartest people sitting at the bar. You can tell your buddies about all these great financial facts that you're learning on Watch Your Six or any other talk show. But at the end of the day, without deploying, it's just information. So I'd strongly recommend that you sit down and you go over that. When you're looking at multiples or profit margins, the S&P of 12, 14%, that's huge. So sometimes you'll hear people talk about, well, the market's overpriced, the valuation's too high. And in some cases that may be the case. But the bulk of the scenarios we're talking about right now still have a tremendous amount of growth. So don't get gun shy and don't get nervous. Don't listen to the one guy on the media that wants to say the world's on fire and the sky's falling. It may be in other areas, but when it comes to finance, economically, a lot of these policies are starting to do really well. Another thing, as we've talked about before, that really never came to fruition, but you heard economists talk about it, tariff. That never happened. We didn't see any impacts of tariff. In fact, companies now have learned to work around the tariffs. And the tariffs have generated revenue for the country, but the companies are also being more efficient and more lean, as well as working with different countries. So now you've created markets in countries that didn't have the opportunity before. And that is a really nice story. When you're talking about smaller markets like Indonesia, Vietnam, other areas, because tariffs were slapped on a company like China, now those workers are getting a chance. Those families are getting a chance to grow. So it's a good thing financially. You're seeing that play out. And as we've said, tariffs really never trickled down like they talked about. The boogeyman never came out of the closet. So you're seeing some incredible opportunities in 2026. I think the caveat is to make sure that you have a strategy, that you've met with somebody on your team, you've created a plan, and that you've positioned yourself to really exploit these opportunities. Because there are going to be, opportunities that you're not going to have years later. And these kind of bull markets, and I've been around now 20 plus years, these different bull markets, I've been through 5 of them and it's phenomenal. And what's really interesting about bull versus bear, when you have these market corrections, even when you have huge dips, the duration of the market correction is almost 60 to 70% shorter than the duration of the bull market. So we're living in a bull cycle right now. You've got policies that allow companies to grow. You've got the opportunity for interest rates to be very low, so now these countries or these opportunities for these companies to get access to capital is going to become better. The consumer is going to start to see a little relief on things like credit card and mortgages. And then when you have that coupled with the fact that as energy costs come down, and when energy costs come down, what does that mean? Well, now the truck that's delivering your groceries, their costs come down. the factories that are producing these goods, their costs come down, and ultimately then the cost to us come down. Now you're talking about more capital in your pocket. And that's critical to the U.S. economy because remember, we've said this before, 70% of the U.S. economy is driven by consumer spending. So we have a very, very open, robust looking road ahead that's going to create incredible opportunity. As I said before, the sectors you're going to be wanting to look at is AI, obviously, but those residual areas that are still benefiting from it, finance, energy, consumer staple, healthcare, and because I described to you though how those opportunities work. Now another area to think about is small businesses. And I always like small businesses because what they call small cap, that's the smaller institutions, have an opportunity to be very nimble. I like to correlate a small cap company to a speedboat and a large cap company to a tanker. So a tanker is powerful, big, robust, but how long does it take it to move or adjust? It's very slow. Speedboat can pivot. So in these kind of economic environments, excuse me, where there's capital fusion or capital infusion coming from different entities, there may be sectors that just start to blow up or pop up because of the industries. The small cap sector is looking to do a 14 or 50% growth this year. So 14 to 15% is nothing to shake your head at. So again, looking at different sectors or looking at different capitalizations is a great way to make sure that you're positioned for 2026, and it gives you an opportunity to really start to make some money in capital. I think we want to look at it from a positive, not a negative. Our perspectives are always slanted by our emotion. Take the emotion out of the equation. I've always stressed, don't put it off. Please don't put it off. I don't care if you meet with our team or meet with any team, but make sure you get with a team, have them tell you what the good, the bad, and the ugly is, and then come up with a strategy. And 2026 is going to be a very unique strategy. We've been pretty right on this show, as you've known. We talked about the tariff that didn't happen. We talked about the correction in crypto. So I think we're going to be just as correct on 2026. So make sure you're positioned, make sure you're ready to take advantage of that, and you're going to enjoy that. Now, we'll be right back with Jason's Fast Five and our DMs, and we'll talk to you soon. Okay, so now we're going to go to our DMs, and then we'll go back to Jason's Fast Five. So we're going to have producer Grady give me some of the DMs. First of all, thank you, listeners and viewers, for coming in on our DMs. Just keep them coming, and we'll do our best to get to them. What do you got, Grady?
First one from Thomas. May I ask what you think of a high-yield savings account?
Thomas, a good question. While on the surface, high-yield savings sound great, here's the downside of it and the upside. The upside is you're trying to keep pace with inflation while mitigating risk. So that sounds good, right? But usually people are putting money in a high-yield saving that they don't need. So now what's happened is you generated interest, and that interest is taxable. So at the end of the year, even though you made 1 or 2%, you end up getting a document and you got to pay taxes on that 1 or 2%. So I would say it depends on the funds you have. If you're putting money in there that is your emergency fund account, it's your 6-month window, then maybe it's just not worth it. If you're in a high tax bracket, it's definitely not worth it. If you're not in a high tax bracket, then fine, stick with that. But I don't like to generate revenue unless I need to use the revenue. That's why there's probably other better ways to do that, but it really all depends on what those funds are generated for and what they're saved for. But that's a great question. Hopefully that answered Thomas. What else you got, Grady?
Next one from 10 Golf Silla. Hi, reaching out because I'm really struggling to figure out a career path. I'm supposed to start dental school in August, but I've been having second thoughts due to how expensive it is, and also not sure if I'm fully into it because my interests and strengths align more with English, reading, and business. I don't know if I should pass the opportunity when it took a while to get into, and also may not get again, or try and go to law school. Not sure what makes sense long-term financially.
So I like, again, I'm not a counselor. We're not a business counselor. It's not our job. But I do like the angle you're taking, because what you're doing, and a lot of people don't do this, you're looking at the cost versus reward. You're saying, okay, what's it going to cost me to get into this field? And thus, how long will it take for me to repay it? Now, that's critical. I don't know how many clients come in here and they're in professions and they've got $150,000, $200,000 worth of student loan debt. So I would say look at the cost for education, look at the cost for those sectors, and then look at the gains, look at the income, what's the average income for those sectors, and then determine what that would look like. So that could be a first place to start. But the biggest thing, and you keyed on your comment, do what you love. If you do what you love, you're going to be successful. But just don't do it blindly. We don't want to go into a sector where we're spending billions of dollars and we'll never make money back. There are sectors like that, unfortunately, where people spend hundreds of thousands of dollars and the industry just doesn't pay that back. So those are good questions, but I think, again, look at the financial costs. So now we're going to be going into Jason's Fast Five, and we're excited about that. A couple things going on. You may have heard about Trump, and Trump specifically talking about banning large organizations from buying real estate. CNN reported that he wanted to ban large institutions. Now, I like that concept, and let me explain why. You don't realize why the price and cost of houses go up. It's not necessarily supply and demand. It's because large corporations are able to buy big pieces of properties in multiple houses in an area. Therefore, they can dictate the cost of that house. And you know, the way Trump put it, he said, people live in houses, corporations don't. So I'm a huge advocate of banning that. I don't think large companies should be able to go buy out a bunch of properties, 10 or 15,000 in a pool. They can then dictate price, use that as an investment opportunity because you, the consumer, are looking for a place to live. So I think that's a very positive. S&P just came out. We had some really high PE ratios. We had Intel at 4602. We had CoStar Group at 1234. We had Palomar at 413. Tesla was at 292. I mean, these are huge numbers. So when you're looking at PE ratios and you're looking at the kind of growth, these give you opportunities to whether a company's overvalued or undervalued. Silver, again, silver is above 90, almost 90 ounces. We're talking about 27% up for the week and 200% up over last year. That's huge. Those what we call raw goods or natural earth goods or particular natural resources are going to become more and more valuable because of the introduction of more AI and more things like Intel and what we call semiconductors because they use those raw materials to build. Trump also revived the 10% credit cap and the spook banks. JP Morgan, as we know, slid 3% and Barclays dropped 2.8%. This concept is a really good concept if it can get into play. Credit card companies are not going to like it. They're just not because, again, they want to charge you the 27, 30%. But if you can get a credit cap where you and I are now got an interest rate of 10% and that's the most they'll ever charge, we're going to use our credit card more, so they'll make money, but you're also not going to be drowning in debt with numbers that are unsustainable on your part. So it'll be an interesting conversation. We'll see what happens. Remember, folks, our ebook is out. Go to our website, download the PDF. It's absolutely free. I think everyone here would love the ebook. We thank you for tuning in to Jason and Watch Your Six. We look forward to seeing you in our next episode. Have a great week.